Hi, hello, namaskara. Welcome back, viewers, to another episode of my channel. It's the beginning of a new tax year. There is always a battle between old versus new tax regime, and especially till February 2026, clear winner is the new tax regime, as 88% of the taxpayers have been shifted to new tax regime. CBDT chairman and chief Ravi Agrawal rules out sunset clause for the old regime. And as an evidence, during February 2026, new income tax draft rules 2026 were announced, which brings about changes with higher HRA benefit for taxpayers residing in Ahmedabad, Bengaluru, Hyderabad, and Pune, enhanced benefit on education allowance, hostel allowance, leave encashment, meal expenses, LTA, and car lease provisions, which initiated the debate on old versus new regime once again with the enhanced benefits. The income tax rules 2026 have been officially notified and comes into effective existence from April 1st, 2026, which means it is applicable for new tax year 2026-27. Let's understand for declarations to be provided to employer by end of this month, which needed for selecting the right tax regime for this current tax year. And later we'll guide you with assessment year 2026-27 filings.
The agenda for this episode is like this. First, we'll go through the tax year 2026-27 regime declarations with an example of gross total income rupees 40 lakh and comparison and framework for assessment year 2026-27 and slab rates at glance and key differences for salary cases. And then we'll have four examples, one with the 10 lakh gross total income, 20 lakh, 30 lakh, and 40 lakh. And key takeaway or conclusion for salaried class, which tax regime suits better for them. So let's understand assessment year 2026-27 versus tax year 2026-27 so that it is very clear to you. We can take an example of salaried class 40 lakhs gross total income comparison as well, just for information purpose. Assessment year 2026-27 under the present Income Tax Act 1961. The system income earned in financial year 2025-26 is assessed in assessment year 2026-27. Assessment year and previous year are two separate references, right? And salaried taxpayers use current slab rates, standard deduction, and cess while filing return for assessment year 2026-27. For tax year 2026-27, under the new Income Tax Act 2025 framework, the phrase tax year refers to the 12-month period itself, usually from 1st of April to 31st of March. It replaces the separate previous year assessment year concept with one simpler term, tax year. This is mainly a drafting and terminology change intended to simplify reading of the law. Right, main difference: assessment year of assessment after the earning year. Tax year, it is the earning tax period, both are same. Assessment year, previous year terminology is replaced by single tax year concept. For salaried person, practical tax working still depends on various factors like income, deductions, slab rates, and cess. And then comparison of 40 lakh salary comparison with straight comparison with the new tax regime and old tax regime. without considering any exemptions or deductions. So with standard deduction is higher in new tax regime, 75,000 as compared to 50,000 in old regime. And then based on the tax slabs, it is income tax will be 7 lakh 42,500 as against the old regime 10 lakh 2,500. And with total tax is clearly a new tax regime is the winner with a saving of 2,70,400. How do you interpret these information under assessment year 2026-27 wording? The return relates to financial year 2025-26 income. Under tax year wording, the law simplified tax income to the tax year itself. In this no deduction example, it is new tax regime is lower by 2,70,400 rupees on tax, which is a saving. In if one has exemptions or deductions higher than rupees 8,66,667 or above, then old regime can be a beneficial regime with good tax savings. Based on your case, you may decide to choose new tax regime or old tax regime. If you have higher exemptions or deductions, namely a large HRA where your owner is providing required details, and LTA is applicable for you, and car lease arrangement with your employer, ATC, ATD, NPS employer contribution, housing loan interest for self-occupied or in principal repayment, then you can opt for the old regime as compared to the new regime, because you will be ending up with higher tax deduction or the exemptions which might exceed the 8,66,667 or above, which will save some tax. Income tax rules 2026 has been notified effective 1st April 2026, and which has come out with various changes to the perquisites to salaried class. There is a higher or enhanced benefits. Here is a comprehensive table comparing all key changes in income tax rules 2026 for salaried taxpayer versus existing rules, with estimated annual benefits or savings of about 300K. We have a detailed video explaining each of these changes, and a link to the video is provided in description for your quick reference. If these changes helps you claim higher deduction exemptions, then old regime might look attractive for you for the current tax year 2026-27, and you might provide the declaration to your employer choosing the old regime to be applicable for calculating the TDS on a month-on-month basis. If you still want to change it, you can change it during the filing of income tax return for this tax year next year, which will be before the July 2027. So you can still change it. So you can go ahead and provide old tax regime if you are eligible for the various deductions, and you can take benefit of all these enhanced benefits and tax savings applicable for you. In simple words, new tax regime, if you are a person where you don't have any savings or investments, and very few or nil deduction exemptions are applicable for you, you can go for the new tax regime. Or if you are a person who doesn't like to store or collate the information documents which needs to be provided to your employer, you can opt for new tax regime. Or if you are with there is no savings habit or any intentions or investments which you have, Then it is a new tax regime which is applicable, and which is a straightforward, simple, no details, lower tax slabs. You can go in for the new tax regime. Or if you have various deductions, exemptions which you are eligible with enhanced limits as per the IT rules 2026, you can go in for the old tax regime, and you are able to store documents or provide details to your employer on various aspects. You can go in for the old tax regime. Or if you are forward looking with savings mindset, then it's a right regime for you. Though it is little bit complex and detailed oriented, where you have to provide all the required details from the income tax department, and then you can go in for the old tax regime. So let's summarize whatever has been discussed so far. So default regime under section 115 BAC for eligible individuals, salaried non-business taxpayers may choose old regime every year in the income tax return. It comes with a new basic exemption is 4 lakhs, standard deduction is 75,000, and section 87A rebate makes tax nil up to 12 lakh taxable income under the new regime. Most deductions exemptions are not available, so the structure is simpler but less flexible in new tax regime. Optional regime with basic exemption of 2.5 lakh and standard deduction of 50,000 for salaried income in the old regime, which allows various deductions, exemptions such as ATC, ATD, HRA, home loan interest, and some loss set off subject to some of the conditions. Best suited when the taxpayer has substantial eligible deductions and exemptions. The slab rates, you can take a look at it quickly. By now, you must be very clear. Old regime comes with 5%, 20%, and 30%, but new regime comes with 5% from 4 to 8 lakh, and then every 4 lakh, 5% of tax has been increased. About 24 lakhs, it is 30%. In old regime, it is about 10 lakhs is 30%. Old regime rebate under section 87A is available only up to 5 lakh total income, while new regime rebate is available up to 12 lakh taxable income. Key differences for salary cases, standard deduction is one of the key difference. 75 under new regime versus 50,000 under the old regime. Rebate impact under the new regime, it can go up to roughly 12.75 lakh, can still become zero tax because 12 lakh taxable income can be a fully offset by rebate after 75,000 standard deduction. Deductions, old regime permits common tax planning benefits such as ATC, ATD, HRA, housing benefits, while new regime allows only limited items. Choice frequency for salaried persons without business income, the regime can be selected every year while filing the return before the due date. So let's understand the example one where the gross total income is around 10 lakh for a salaried class. A new regime, it is 10 lakh and standard deduction is 75,000, and taxable income is 9 lakh 25, and the tax before rebate is 32,500, and rebate which you are eligible under section 87A will be 32,500. So that makes zero as your tax liability, whereas old regime, it comes with standard deduction of 50,000, and there is a including cess, it is about 1,06,600. So in this case, there is no deductions which have been considered, and the straight comparison with the slab rates, it's a new regime is the clear winner, and you can go in for that. If you have better salary structure from your employer and you are eligible for more deductions, exemptions, I can show you another example, practical scenario where you can opt for based on the result. So let's see a practical scenario where you have various salary structure provided as per your employer, and you have provided the details monthly as yearly as this much, and that 14 lakhs is the overall salary income, and you are eligible for the car lease, official purpose resident office, and any other official purposes. So you have some limits on monthly EMI and expenses reimbursements that will cover, and you are eligible for LTA and HRA. With Bengaluru, it is 40%. So that is something which has been calculated. And then professional tax and then standard deduction income from salary is around 9 lakhs. Considering there is an house property income of 2 lakh 50,000 and you are paying interest, housing loan interest and deductions, and then net income chargeable to tax is 55,000, and interest from FDs and dividend received, it is about 40,000. So gross total income is about 10 lakh 15,950 as under old tax regime. And the new tax regime, it comes to 12 lakh 73,350 because there are no deductions of LTA and then HRA, and then car lease is still continuing in new. So that is the difference. And then considering ETC, which you fully cover with EPF amount, what is coming out, and then some of the other insurance or any other eligible investments, and then employers contribution 45,000 and 80 ccd self contribution of 50,000 additional deduction, ATD 25,000. If you have parents insurance covered, you can consider another 25,000. And then if you have interest from deposits or the savings account, it is about 10,000. So considering the 2 lakh 80,000 under old and 45,000 under new, so total income comes to 7 lakh 35,950 and 12 lakh 28,350. Based on this taxable income, tax payable, and considering the tax payable, clear recommendation is the new regime, because uh, you will be saving about 32,594 by opting the new tax regime. If you think car lease arrangement is not there with you, with your employer, or you don't want to go in for that, if we exclude that and then see what is the revised decision and tax savings, it is still going with the new regime, and then there is a tax saving of 6,000 for this particular income group. Similarly, for gross total income of 20 lakhs, it is based on the straight calculation. Uh, with no major deductions, no, the new tax regime saves about 2 lakh 26,200 compared to the old tax regime. And let's understand with one practical example. So again, in the similar case of where you have option to select the various salary structure at the beginning of the year, and then various things which you can select from your CTC, and then you are eligible for the car lease and then LTA HRA, which is available for Bengaluru. Standard deduction under old is 50 and new 75,000, with additional income on house property, and then other income of 80,000. The gross total income is about 21 lakh 29,300 under old, and the new 25 lakh 66,700. It is employ the Considering the deductions under Chapter 6 ATC 1,50,000 and 90,000 for NPS employer contribution, and then NPS self contribution of 50,000, ATD 25,000, and if you have senior citizen parents, you can consider another 25 lakh or based on actual eligibility, and then 80 TTA 10,000 as a additional deduction. Considering all these deductions, old is 3,25,000 and new is 90,000 as a deduction. Considering the tax payable, total tax payable, it's a new recommendation is new tax regime, which saves you 32,000 as a savings. To make it old tax regime as a better, you will have to have increase your deductions or exemptions to the tune of 1 lakh 2,600 or higher, so that old will be attractive. So in the third example, gross total income of 30 lakhs, it's a straightforward without in considering any deductions. It's at a new regime saves 2 lakh 70,400 under a no deduction comparison. So let's check it out with the new practical example. Similarly, with the various CTC salary structure which you have opted, and then you have the car lease agreement, LTA, HRA, uh, and then you have the house loan interest which needs to be claimed, and other income to the tune of 1,20,000. It is about gross total income is 32 lakhs in old and 38 lakh in new. Based on the tax liability, it is clear winner is the old tax regime, which comes with a savings of 24,149 as a clear winner. If you consider that there is no car lease benefits which you are opting for, and then that is not applicable for you. If I exclude that, and then it is still old regime is the clear winner, and then 24 lakh 24,149 is the savings. So in the fourth example, with a gross total income of 40 lakhs, straight comparison with the slabs, and new tax regime saves 2 lakh 70,400, where the taxpayer does not claim old regime deduction. A similar structure or the salary structure or various components which have been provided by your employer, car lease, LTA, HRA, home loan, other income which has been included, and you are claiming the full ATC, and then employer contribution to the maximum possible, and then ATCD, self contribution, medical insurance ATD 25,000, and you can consider additional amount for if you have senior citizen parents or within the normal structure, and then interest from deposit 80 TTA 10,000 with a deduction of 4 lakh 15,000 under old, and new 1 lakh 80 with the total tax payable. It is recommendation is old regime with a saving of 42,869 as a total savings. If you consider the car loan is not applicable, and it is not you are not eligible, or you are not going in for that procedure, so what is the revised recommendation? It is still old regime, and then there is a savings of 42,869 as a, because it is taken out from both the tax regimes. So, summary for the straightforward slab rate calculation, it is 1 lakh 7,000 saving on 10 lakh income, and then 2 lakh 26 thousands is the savings for 20 lakh income, and then 2.7 lakh savings of 30 lakh income, and 2.7 lakh savings at 40 lakh income as well. So with various salary structure opted and practical scenario of various deductions exemption which have been claimed, for 10 lakhs it is new regime, 20 lakh also new regime with a saving of 32,000 each, and then for 32 lakh it is old regime with a saving of 24,000, and then for 40 lakh it is about it is the recommendation is old regime with about 40 to 43,000 tax savings. So if you still have a question, when can old regime still win? So it is old regime may be better when you claim large HRA exemption, home loan interest on self-occupied property. You have ATC, ATD, and other eligible deductions together, namely like car lease arrangements with your employer, LTA, and other things. Your total deduction exemptions are high enough to materially reduce taxable income compared with the lower slab benefit of the new regime. So that is another aspect. You want to use deduction heavy tax planning structure based on your salary package and investments, then old regime may be better. Right. Practical thumb rule, it is for many salaried taxpayer without a major exemption. New regime is the simpler and which comes with the lower tax slabs. Once deductions become substantial, run both calculation before filing the return, instead of assuming old regime gives the better situation or the savings. It is always better to compare, and then comparison in this deck is a baseline comparison, and then also I have shown you the Excel calculation with better salary structure and then various deduction and including house property and other income. What will be the recommendation? Right, so that is also covered. And then conclusion for salaried taxpayers for assessment year 2026-27, new tax regime generally produces lower tax for salary cases with limited deductions, while the old regime becomes relevant only when you have higher exemptions, deductions, and you have all the supporting documents which are required for HRA or the ATC or the home loan interest or various the car lease arrangements. If you have that, then to offset the with the higher slab rates, then you can go in for the old regime. So lower new regime where you come, it comes with the lower slab, 75,000 standard deduction, up to 12 lakh plus rebate threshold is covered. Up to 12 lakh 75,000, you don't have to pay any tax. It covers with the rebate, and then old regime choose only after testing the effect of HRA, ATC, ATD, and housing deductions. And then best practice is always to compare both regimes using your actual form 16 details and any other income like house property or other income or capital gains. Then you compare. There is various online tools including the income tax portal where you can check the tax payable based on the gross total income or taxable income, which comes out and tells you how much under the old tax and how much under the new tax regime. So based on that, you can take a informed decisions. So hope this episode helped you to understand the new versus old tax regime for assessment year 2026-27 and tax year 2026 and 27, and able to file the declaration with your employer for assessment year, not assessment year, tax year 2026-27, and able to file with the right regime to save taxes for your for to assessment year 2026-27 before July this year with more confidence instead of having confusions and hesitations. you have not subscribed to my channel, please follow, subscribe to my channel, share feedback, and click on bell icon for receiving the notification on new videos uploaded with new topics, which is beneficial for the salaried class. Till then, signing off from this episode. Thank you very much for watching till end of this episode, and take care. Happy filings and declarations. Thank you.